Hello, happy Wednesday, everyone. So today we're going to discuss and talk a little bit about this 401k plan, or better known as the New York State Secure Choice Savings Program. And that requires that all New York State employers with 10 or more employees that have been in business for 2 or more years that do not currently offer a qualified retirement plan to its employees establish a payroll deduction mechanism to enable their employees to participate in a state-run IRA program. Now, at this time, this program for the SCSP, it has adopted the bylaws already. It has passed a resolution delegating the program's development and implementation to the New York State Department of Taxation and Finance. However, no enrollment date has been set. Now, this means that some of the things that we'll discuss today could still be changed slightly, but for the most part, the most important thing to know is that employers will have 9 months to implement the program once the enrollment guidance is issued. And from what we've seen in the past with paid family leave in New York, which was likewise a payroll deduction, such a short period of time for a company that's not prepared could really put the company behind that deadline. So it's very important, and this is why we're having this discussion now, because once it's adopted and once the enrollment date has been set, the 9-month period will go very, very quickly. And we want to make sure that the companies are ready to work with their legal team, with their accounting team, with payroll to make sure that everything is being set up. So the program is a New York State-run retirement savings program. It's going to function as a Roth IRA. The employee contributions will come from the employee's post-tax income, and then distributions therefrom will also be non-taxable. The employees will be eligible to deposit up to the IRS maximum limits, and employees will be able to withdraw the funds in accordance with the rules surrounding other IRAs. Some employers' responsibility will include enrolling the employees, and they'll be required also to hold an open enrollment period at least once a year. Also to ensure that the proper withholding of the employee contributions is being taken, and that the employers do not, although are not required, but a lot of policies will be in place to match some contributions. So this is something to think about as well before that enrollment period comes into effect. What will the employer, what will the company offer to its employees as an incentive? Will they be matching? If so, this all needs to be set up properly and ahead of time. Now, Jane, I just wanted to ask you a little bit more information on the employer's responsibility on your side.
Sure. Hi, everyone. So under the new proposed legislation, employers must be automatically enrolling eligible employees into their individual retirement savings accounts, which is IRAs. They have to deposit their funds into the IRAs, and they have to retain records confirming compliance for at least 3 years. So the employees, they could be opting out of the program. They could adjust their contribution rates or do nothing at all. Each IRA is portable, so if they change positions, it rolls over. And they could also, for the employers, they don't have to really do any matching. So they're only kind of looking at administrative setup fees. There's no mandatory contribution matching requirements. And the IRAs will be funded with deductions from their wages. And so we were also looking at the penalties, the proposed penalties for noncompliance. So basically, if the employers fail to enroll their employees or to deposit employee funds into IRAs, we're looking at the first violation is $250 per employee. If there's a second violation within 2 years of the prior violation, we're looking at $500 per employee. And then third and subsequent violations, we're looking at $1,000 per employee. In addition, if the employer fails to maintain proper records and compliance, we're looking at $100 fine per violation. And also, once we have more guidance, we'll do a follow-up podcast since the proposed regulations might have changes. So we're going to keep an eye out. And if you have any questions in the meantime, please feel free to reach out to us. Bye.